Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan and Imad. And we are talking about banks this morning.
We are indeed. Ryan, which is the longest established Singapore bank?
I'm thinking DBS because it's been around for many folks, and I think a lot of people grew up with DBS and the POSB account, so I'm thinking DBS.
Close but no cigar. OCBC was actually born out of the Great Depression through the consolidation of three banks in 1932. The Chinese Commercial Bank Limited, incorporated in 1912, the Ho Hong Bank Limited in 1917, and the Overseas, minus the S, Chinese Bank Limited, incorporated in 1919.
Okay, so OCBC is the oldest established bank in Singapore, and timely that we are talking about it because their earnings are out this morning, and we are looking at the first quarter profit falling on lower net interest income and higher operating expenses. So that's coming in at 1.88 billion compared with the 1.98 billion a year ago, and is a beat on the consensus forecast of 1.86 billion. So altogether, it does look like a bit of a mixed bag of earnings for OCBC. Helping us out this morning, Yeap Junrong, market strategist for IG. Good morning, Junrong.
Hey, good morning, Ryan.
Yeah, Junrong, it was a bit of a mixed bag, as we said. Let's take a look first at some of the bright spots, if you can highlight some of those for us.
Yeah, I think to round it up, I think sort of a mixed bag here. Total income up 1%, but net profit contracted 5%. And I think, as you mentioned, I think the weighing block is the 4% decline in net interest income, along with higher provision for allowances that actually increased 25%. And this is the first year-on-year drop in net profit since first quarter 2022, really mirroring that of DBS as well. So even though it came in at a slight beat, I believe that there is some sort of a underlying weakness being involved right here.
Yeah, I think it comes down to expectations, right? To some degree, we are looking out for this to happen because of the backdrop of margins being under pressure, of net interest margins. The rates are expected to be cut later this year. And of course, the wider environment is not so great right now. So to what degree does this fall in line with your expectations?
Yeah, I think I was actually expecting kind of a smaller drop in terms of net interest margin. But what we have seen here is a 23 basis point drop to a 2.04% at the latest quarter. That compares with a 2.27% a year ago. So OCBC net interest margin, we know tends to be the highest out of all three banks. But from the recent results, it has also eased the most. And we know that the Fed has not actually cut rate this year just yet, but we are seeing sort of a taper off in terms of Singapore's lending rate based on the series of rate cuts last year, along with expectations that the Fed's rate cutting cycle will resume in the second half of this year as early as June. But of course, I think at least some pocket of optimism here is that loan demand actually grew 7%. So that sort of helped to offer somewhat of a cushion for this fall in an interest margin. So we are still seeing that lending in first quarter still remain resilient from both the consumer and business side of things. So there are higher mortgages, higher corporate loans. But I would just put on a note of caution here that most of the loan demand growth that we see is actually before Trump's reciprocal tariff plans. So the risk here is definitely that could be challenged ahead if global trade dynamics do not improve.
Yeah, funny you mentioned that, Junrong, because CEO Helen Wong actually said that the heightened uncertainties brought about by the shifts in trade policies, geopolitical risks, and what's happening on the tariff front, the tensions there, are expected to have a dampening effect on overall economic growth in the region. So against that backdrop, what is OCBC's outlook for the remainder of the year?
Yeah, good question, Imad. I think what we have seen throughout this whole week is that initially, UOB actually pauses guidance, but they remain optimistic about ASEAN growth. And if you look at DBS yesterday, they sort of, broadly maintain its 2025 guidance. But of course, they expect more rate cuts in the second half of this year. They expect 3 rate cuts versus the previous 2 that they initially guided. Now for OCBC, I think their stance seems to be leaning more towards DBS in that sense. So they highlighted heightened uncertainty. I think they're totally sort of less optimistic than UOB, who still remain kind of confident around ASEAN growth. So OCBC did highlight, once again, not a surprise, the shift in trade policies, geopolitical risks. So they actually, in their own words, say that it is expected to have a dampening effect on overall economic growth in the region. If you look at these hard numbers, OCBC maintained at our 2025 guidance, net interest margin in the region of 2%. I'm looking at that, and that could mean that there could still be further easing in terms of the net interest margin ahead. They also keep the loan growth at around the mid-single digit. So in a way, we could expect somewhat of a softening from the current 7% as well. Credit costs, they keep it in the range of 20 to 25 basis points. So I think in a way, their stance sort of mirror those that we have seen, not just in Singapore, but also across major global lenders such as HSBC and Standard Chartered, which highlighted the threat to economic growth from US tariffs. So I think it's really more of a wait and see moving forward. But, for now, it does seem that downside pressure to growth cannot be ignored.
Yeah, let's talk about the allowances they are setting aside for non-performing loans. And to that point, with OCBC, with exposure to China, how is it going to play out for them? Because China, of course, facing the most in terms of tariff headwinds. Where do you see this going?
Yeah, I think what we have seen is a similar trend across all three banks. They up their overall provisions to weather against any economic uncertainty. So OCBC provisions were up 25% year on year to 212 million. UOB was up 78%. More significantly is DBS, which up 140% in terms of their loan loss provision. But if you dive into the details, into the component of these loan loss provisions, much of it came from general provision. So that means those that are more of a broad kind of uncertainty around the loan loss risk as compared to a specific one. So I think being the prudent way that Singapore banks are, they are already starting to allocate more capital towards weathering any form of impact from US tariffs. And it's no surprise because I think we have heard just last month, the MTI kind of downgraded Singapore's 2025 GDP forecast to 0%. So that is sort of a zero growth moving forward. So I think they are sort of preparing for somewhat of a worst case scenario. But of course, if you just look at the underlying balance sheet of their loan book, it still remains resilient at current point in time. If you just look at OCBC, their loan loss ratio is just 0.9%. That is still at a very, very healthy range. And if you look at its capital positions, a strong CET1 ratio of around 14.5%. So in a way, they have that strong capability to weather any economic impact. But of course, they are sort of preparing for some sort of a bad weather ahead.
OCBC was the last of Singapore's three lenders together with UOB and DBS to release their quarterly results. A bit of a mixed picture for OCBC. DBS posted better than estimated net income and maintained most of its profit guidance for 2025, while UOB reported little changed numbers but suspended its outlook for the year. So against that backdrop, Junrong, how attractive are banking stocks right now?
Yeah, of course, now we are seeing some sort of a earnings rollover. I think it's kind of expected, and it's kind of a delayed impact from the Fed rate cutting cycle. And now we are looking at a greater macroeconomic risk, especially coming from a US tariff, which really nobody knows where things are headed to. But in a way, I still believe that the banks sort of offer a very strong income proposition. If you just look at its forward dividend that I sort of calculated, OCBC actually stands at 5.4% dividend yield. UOB stands at 5.2%, DBS stands at 5.5%. So looking at those numbers, those are one of the highest dividend yield across Asian banks that you can actually get. And as I mentioned, some of their capital positions, are way past the minimum requirement. So in a way, their capital positions are very strong. And of course, their valuation remains reasonable as well. So I think that income proposition cannot be ignored. But of course, given that strong run-up in terms of share price that we have seen over the past year, with that earnings rollover, I think there could still be some slight profit taking, at least in the near term.
All right, great wrap up of how banks have been doing in this earnings season. And helping us out this morning, Yeap Junrong, market strategist for IG. Junrong, thanks for your time this morning.
Thank you, Ryan.
Great having you on as always. Catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.